Thank you very much, Kriben, for joining us. So on a year-on-year basis, new vehicle car price increase have slowed quite dramatically, rising by 2%, while conversely used car prices have ratcheted up quite substantially, up by 7% in the fourth quarter. What are the drivers behind these developments?
Yeah, absolutely. Thanks for having me. On the new vehicle side, firstly, the 9.6%, as you can appreciate, was quite aggressive a year ago. In relation to CPI at the time, CPI was at 3.8%. That's almost double, or if not almost 3 times actually, CPI. Naturally, what we see when we have periods of excessively high vehicle price increases on the new side, consumer behavior does shift and move more towards buying of used vehicles, as we've seen now in the recent trend. That in turn obviously creates higher demand for good quality used stock, which then pushes up the pricing. Some of the context though is that under normal circumstances, you would see these pricing shifts. In the current context though, the problem does get a bit more compounded with the supply issue we're having at the moment. If you look at new vehicles, there's been severe impact to the supply chain with regards to the semiconductor shortage. The bulk of vehicles in South Africa on our roads are imported into the country. So these are the dynamics that play out when it comes to pricing.
Now, when it comes to the financing of vehicles, what trends are you observing in both the new and the used car markets?
Yes, so from a volume perspective, overall, we actually saw some lift in Q4 last year. So the total finance market, new and used, is probably up around 2.8%. From a new perspective, we saw that up around 2.6%, and used is 2.9%. The largest portion of vehicles, though, the segment that gets mostly financed, is actually vehicles in the category of your SUVs and hatchbacks. And I guess just almost 75% actually of the total pool of vehicles that are being financed are in those categories. And it really does speak to just consumers' need for practicality, the overall value proposition. We've seen a lot of consumers in the current market. If you're looking to downgrade from a 2-vehicle household, and it could have been a household that's got 2 sedans as an example, they're rather opting for something more practical and are moving into the SUV market as an example.
Of course, we know that consumers remain under pressure for various economic reasons. So to what extent do you think the higher interest rate environment is going to actually put people off going out to finance cars and perhaps keeping the vehicles that they currently have for longer?
Yeah, look, all of the surveying that we've done to consumers directly, all of the data points that we have still says that consumers are severely under financial distress. In disposable income is strained. The interest rates wasn't at an all-time low, and for the first time in 3 years, we see an increase. Fuel prices almost over 20 rand a litre. This does drive lower consumer confidence. It seems to be, a bit contradictory when we enter the year and we see new vehicle sales increase year on year at about 19.5%. But the reality is it's coming off a low base. As much as we're getting the year on year and the month on month growth overall, we're still not to the point of pre-COVID levels. We probably, from a new vehicle perspective last year, passenger vehicles, we were probably around 50 to 60,000 vehicles short on sales as we were the previous period in 2019. So, we remain sort of cautiously optimistic for the year. There definitely are some signs that the market's improving at a steady pace. But I think equally, we enter the year with some headwinds. The interest rate is one, the fuel price is one. We do see, load shedding becoming an issue through the course of this year. And overall, when we see periods where GDP is not growing at the rate that it should, there's a direct correlation to the new vehicle market. If you have growth in GDP, we naturally see growth in the vehicle market. The converse is true as well, though.
Yeah. Very quickly, what's your observation around the export market? I mean, pre-COVID, that was a very thriving market, but what are your observations recently?
Yeah, we have seen slight increases coming off the back of last year. There was probably around an 8.8% increase in exports. Clearly, there were significant headwinds specifically to exports. Last year, the Transnet force majeure and the cybersecurity attack that they had created an issue with exports. There were strikes, the civil unrest. All of that did contribute to the lower volume of exports that was done. Notwithstanding, the overall global demand was much lower than previous periods. We're still all in the middle of the pandemic. We're probably about to hit our fifth wave in winter. So exports, I think, from a year-on-year perspective, absolutely it's in the right direction. We're probably looking at around, a conservative view of about 15% growth on exports this year, which really, is a story to be told on its own, because pre-COVID, export volumes were really on the rise, and that only, sort of holds the economy in good stead.
Indeed. Kriben Reddy, thank you very much for your time, sir. He's the Vice President of Auto Information Solutions at TransUnion.